Alright, this is a video solution to the Veronika App problem, and we're looking at the situation where Veronika is going to go pay somebody to develop an app. It's an asset, just like if she paid somebody to deliver a great big old Cat D9 bulldozer or to build her a factory. Okay, so she's going to buy this app built from an engineering contractor, and it's a game engineering contractor, and they're going to charge her $175,000 to put this thing together so it's ready to run. Even after it's built, the engineering firm has demanded they get a slice of the pie on anything that they actually sell through this process. So they're going to get 18 cents every time the app is downloaded. Now, Veronika is not going to buy her own host server to do all this crap. She will go to somebody like Amazon who has a cloud hosting service, and so she's went and found one, and the firm, her web hosting firm, is going to charge her 12 cents per month per active user. Alright, so look at some other expenses. Veronika has to spend $25,000 in each of the first 2 years just to market the game, and then after that it'll take care of itself. She doesn't think the game will last but about 4 years, and the downloads and users are going to drop off very precipitously after the first 2. There are no salvage costs, so when this thing's used up, it's used up. As for revenue, every time a user downloads the app, it'll be $1.99, and she expects to earn 78 cents per month per active user in advertising and promo. Okay, so the download people pay $2, and then it comes with ads on it. In fact, y'all might see those popping up on my dossier every now and again, because I didn't pay the extra money to have it not say dossier. But anyway, that's another way of making money over time. So we've got a table on there that shows downloads, estimated downloads per year, and the average monthly users per year. And we can actually use this to reproduce the revenue and expenses and forecast what the cash flows are going to be. A couple other expenses: $240,000 a year in other operating costs the first year, but it'll drop to $200,000 the second year, $100,000 in years 3 and 4. The $175,000 of development costs. Okay, that's just like buying a depreciable asset, but it's an intangible, so you can't touch it. So we're going to call it amortization. But amortization is how you depreciate non-tangible assets. All right, so it's got some special tax laws. You can amortize it or depreciate it for 3 years by claiming 60% of the cost in year 1, 35% in year 2, and 5% in year 3. And accelerated depreciation is actually a fairly common event for tax purposes out there in business world. All right, Congress grants that stuff all the time in order to get people to develop stuff or because they've been lobbied. Cost of capital is 15%, average tax rate's 30%, and we want the groups to go out there and calculate NPV, IRR, profitability index, payback, and interpret the results. Okay, so this will be it's pretty straightforward, but it gets a lot faster the more practice that you have in it. So the first thing I want to do is start laying out my table here. And I'm going to start with labeling the years or the periods. Year 0 is today. Years 1, 2, 3, and 4. And then from here we'll start by reproducing the data in table 1, or the table in there. So this is downloads. Of course, you don't have any in year 0, but downloads: 250,000 in year 1, 150,000 in year 2, 60,000 in year 3, and 30,000 in year 4. Then we assume it's just going to wither away and die. The average monthly users per year. Okay, that'd be 18,750, 22,000, 12,000, and 8,000. Okay, when we're forecasting out the annual revenues, I've got average monthly users, but that's per month, and there's a revenue and expense that goes per month with the users. So the download charge is a one-time thing, but the advertising revenue and the hosting expense are an ongoing thing. So I need to convert those into annualized numbers before I get too far into the weeds. Alright, so if we start looking at the other things, I know the downloads, I'm going to add the dollar numbers for all of this, the revenue per download, and that's $1.99, and I'm just going to copy that over. That's the revenue for the download. Then there's the revenue per monthly user, and that's per month per user. So that's going to be the advertising will be 78 cents a month. Alright, so those are my sources of revenue, and I have some expenses. That is the engineering firm's cut or commission. That'd be per download, that's 18 cents. And the web host, that would be 12 cents per month per active user. Okay, so given all this information on the table, I can start computing what my estimated revenue is. So the revenue would be every time you download it, or somebody downloads it, that's $1.99 plus $0.78 per monthly user. Okay, so there's my grand total revenue that we're expecting the first year. By the way, if you go through here and do one column, it makes it easier because all the numbers are going to stay the same going over. Alright, so the next thing we want to do is the cost of revenue. And the cost of revenue is going to be 18 cents for every download plus 12 cents times the average monthly users times 12 to convert it to an annual number. Now, it's important to keep in mind that the download is a one-time thing, and it has its cost structure, and the average monthly users actually create both revenue and expense as they're going. So, we have revenue, we have the cost of revenue. We could calculate gross profit from there, but we don't really need to go into that level of detail. Another expense is the ongoing operating expenses. Let me go ahead and copy these over because they're going to stay the same. Same formula, different numbers. Call it SG&A, other operating expenses, and those are pretty hefty the first year, $240,000. In the second year, it's $200,000. And then it's $100,000 in years 3 and 4. All right, so that's another expense. we're going to have to spend $175,000 of development costs at time zero. I'm going to come back to that, but when we're doing the revenue side, I add a row up in here. This is develop the app. That's going to cost $175,000 right off the bat. All right, but that's also going to generate, I can't claim that expense yet. I get to claim the expense over a 3-year period. So this is the depreciation or the amortization of the app itself. In year 1, the proportion is 60%. So 0.6 times absolute value. I'm making everything financial statement looking numbers. Alright, so 60% of 75,000 the first year, 175,000 rather. It's going to be 35% the second year, and the remaining 5% in the last year. And then the depreciation expense in the 4th year is 0. Oops. I said 0. Okay. And then there's one other expense that we need to add. That's $25,000 of special marketing expense in the first 2 years. Alright, so in marketing expense will be $25,000 for the first 2 years, and then 0 in years 3 and 4. Alright, so my operating profit, I have revenue minus all these expenses. That would be the revenue minus the sum of all the expenses for each year. Alright, the income taxes at 30%. Copy that over, and that'll give me the after-tax profit. After-tax operating profit, I guess I should say. And that is a big chunk in the first year, then it drops precipitously, and then it's almost not worth doing in the last year. Now, to do capital budgeting, I don't need after-tax operating profit. I need after-tax operating cash flow. I need to add back that depreciation expense because we actually paid that expense in time period 0 up front. So we're converting everything to cash flows. I only get to take the depreciation expense slowly over the next 3 years. And what that does is reduce my income taxes, so I have to recognize it when I'm calculating my cash flows, but really what I'm using it for is to estimate what the tax impact was. After tax operating cash flow, which is EBIT times 1 minus the tax rate plus depreciation. So after-tax operating profit is EBIT times 1 minus T, and then add back the depreciation expenses. That's the actual cash flow for the year. Okay, so we've already established that there are no terminal values, so if I'm putting together my cash flow line, by period, then that's period 0, 1, 2, 3, and 4. It's going to cost me $175,000 up front. my after-tax cash flows. And now I can compute things like the IRR, my internal rate of return. Misspelled IRR, that's almost funny. So I have 110%. Well, that's pretty hefty. I want to do my MIRR because the IRR overstates the rate of return. The only difference in them is that I compute it the exact same way, but now I have to tell it the finance rate and the reinvestment rate. Use the cost of capital for that. And it's 43%, which is still pretty good. The present value of the future cash flows, use the NPV function, NPV, 15%, and then take the present value of these other cash flows, 419,000 and change. The present value of the initial outlay would be the 175,000. So if you subtract 175,000 from the 419,000, that's the capital NPV, the net present value. $244,000, still sounding like a good idea. And then the profitability index would just be the inflows divided by the absolute value of the outflows. 2.4, make it 2 point, take it 2 decimal places. Okay, so this thing looks wildly profitable no matter how you slice and dice it. But this gives you some of the justifications. As you're looking through there, one thing that you should pay attention to whenever doing capital budgeting, all this depends on these numbers. If you don't do, you're going to pay $175,000 up front. You know what that number is going to be. And if you have 0 downloads, well, then your cash flow is negative $175,000 followed by a string of zeros or a string of other expenses that you're going to have to pay, including these marketing expenses. Hard to believe you could spend money and not get anything, but it happens. So when you're doing these calculations, these are the correct answers if these are the right inputs. If you've predicted the future perfectly, and those are your downloads and those are your monthly users, then good on you, you're the perfect predictor. Nobody is. So that's where it's very important when you're doing these apps, is to pay attention to what happens. What if we actually screwed this up? For instance, what if this is only about 25%, meaning that I overestimated the living bejesus out of it, which would mean that more than likely my average users is going to be a little bit lower. And so if I go in there and then change or do a little what if, uh-oh, 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 then it turns into the worst idea anybody ever had. So you lost $175,000 right away, $50,000 the next year, $60,000 the year after, $31,000 the year after, another $50,000. Essentially, you just cremated about $375,000 worth of value. It doesn't have an IRR because there was never any return. So the hard part with capital budgeting isn't plugging these numbers into a formula. It's coming up with the forecasts that are reasonably accurate. And that's where the art form comes in. And the other part of the art form is having your ducks in a row so that when you go out there and actually do this and things don't turn out like you thought they would, what do you do when this turns into a real stink bomb? So that's why we do all this effort on capital budgeting.